Over the next 18 months, you're going to watch an economic contagion spread across America. It started in Silicon Valley. Now it's hitting your local bank, your favorite stores, and cities you never thought had anything to do with tech. This isn't another tech layoff story. This is about how the collapse of high-income spending is creating a chain reaction most people won't see until it's too late. I'm going to walk you through 3 stages of this contagion, show you the data that proves we're already in stage 2, and explain why 2026 is going to look completely different. For 18 months, everyone called the tech sector problems an internal correction. Layoffs, restructuring, shrinking margins. Wall Street saw it as contained, just cleaning up pandemic excess. But something changed last quarter. The cracks aren't staying inside tech anymore. Here's what we're talking about. Over 260,000 tech jobs eliminated in 2023 and 2024. Average salary of those jobs? Between $180,000 and $220,000. That's $47 billion in annual spending power, just gone from the economy. When a software engineer making $200,000 loses their job, it's not just one person unemployed. It's a high-velocity consumer suddenly removed from the marketplace. And what happens next is just starting. Stage 1, the consumption collapse. The high-end service shock. Let me show you what this looks like in the real world. In San Francisco's Marina District, a Michelin-recommended restaurant just closed. 8 years in business. Not because of bad food or bad reviews. Their customers disappeared. Tech workers who drop $150 on dinner without thinking twice? They're gone. The numbers tell the story. High-end restaurant reservations in San Francisco are down 34% year over year. Premium fitness memberships, the ones over $200 a month, down 28%. Luxury car sales in tech hubs, down 41%. This is what I call the consumption waterfall. Tech workers weren't just employees. They were holding up entire local economies. The wealth effect reversal. But here's where it gets really bad. Tech workers don't just spend their salaries. They spend based on their stock equity. At major tech companies, your compensation breaks down like this. Base salary is maybe 40 to 50%. Stock equity is the other 50 to 60%. So when your company's stock drops 40%, you don't just lose paper wealth, you completely change how you spend money. Look at Meta employees. Late 2022, Meta stock went from $380 down to $88. If you're an employee with $500,000 in unvested stock, you just watched $350,000 disappear. You're not buying that Tesla. You're not upgrading your house. You're cutting everything that isn't essential. The data backs this up. Discretionary spending by tech workers is down 52% since 2022. High-end travel bookings from tech hubs, down 38%. Home renovation permits in Silicon Valley, down 45%. Capital realignment over headcount. Here's the shift everyone's missing. Tech companies aren't just cutting costs. They're moving money around. The money that used to go into paychecks is now going into AI infrastructure, automation systems, cloud optimization. Check this out. Tech sector capital spending is up 67% year over year, but total tech payroll? Down 23%. Corporate balance sheets look great, but the consumer economy is drying up. Stage 2. The financial fracture. The credit squeeze. Now watch what happens when this spending collapse hits banks. Western Alliance Bank is heavily exposed to tech lending. Their Q4 earnings just showed something alarming. Non-performing loans up 340% year over year. New loans to tech contractors? Down 78%. When tech companies stop spending, thousands of vendors and contractors lose their main income source. A lot of them borrowed money expecting that income to continue. Banks are watching this happen in real time. Business loan defaults in tech-adjacent sectors are up 156%. Credit availability for tech contractors down 62%. This creates what I'm calling a funding desert. Even healthy businesses can't get loans because banks are rethinking their entire risk model. The commercial real estate time bomb. Empty office buildings aren't just about remote work. They're sitting on bank balance sheets like ticking time bombs. Here's a specific example. 350 California Street in San Francisco. 22-story office tower, just sold for $70 million. In 2019, it was valued at $300 million. That's not a discount. That's a 77% wipeout. Nationally, here's the scale we're dealing with. Office vacancy rates in tech hubs are at 32%. That's the highest ever recorded. Commercial real estate loans coming due in 2025 and 2026, $1.5 trillion. Estimated value decline, somewhere between 35 and 50%. Here's why this matters. When companies like Meta cut their office space by 30%, they're not just saving on rent. They're destroying the value of assets that banks are using as collateral. Regional banks hold $2.7 trillion in commercial real estate loans. If even 20% of those loans go bad, we're looking at a capital crisis that could make 2008 look small. Fintech transaction collapse. Financial services companies depend on high-value, high-volume transactions. Tech workers generate these at massive scale. Stock trading, crypto, premium credit cards, mortgages. Since tech layoffs picked up speed, here's what's happened. High-value stock trading volume down 44%. Crypto transactions from high-income accounts down 67%. Mortgage applications in tech hubs down 58%. Fintech companies built their entire business models on this transaction volume. It's disappearing. Look at Robinhood. Their high-value traders, the ones moving $50,000 or more, dropped 41% year over year. These weren't casual retail investors. These were tech workers with money to move around. Stage 3. The retail reset. The death of the inflation-proof consumer. Now, the contagion hits Main Street. Retailers thought high-income professionals were recession-proof. They were completely wrong. Lululemon just reported something shocking. Their core customer, affluent professionals making over $150,000, is trading down, not to competitors, to the sales section of Lululemon stores. Same-store sales growth went from plus 18% down to plus 3%. Average purchase amount down 12%. Full-price purchases down 23%. If Lululemon customers are feeling pressure, this contagion has reached the professional class. Across high-end retail, it's the same story. Nordstrom comparable sales down 8.4%. Williams-Sonoma down 9.2%. RH, which used to be Restoration Hardware, down almost 19%. These aren't luxury brands for billionaires. These are brands for upper-middle-class professionals. And they're all struggling. The efficiency arms race. Retailers are responding the only way they know how. They're copying what tech did. Cut everything, optimize operations. Macy's is closing 150 stores over 3 years and cutting 2,350 corporate jobs. Target is reducing store hours by 20% and automating inventory. This protects margins in the short term. But here's the problem. Every retail job cut is another consumer with less money to spend. The efficiency gains eat away at future demand. Regional contagion spread. This isn't just San Francisco or Seattle anymore. Austin, Texas. Retail sales down 11%. Denver, Colorado. Restaurant traffic down 16%. Raleigh-Durham, North Carolina. New business formations down 22%. Portland, Oregon. Commercial lease rates down 28%. All these cities wanted to become the next tech hub. Now they're learning what happens when tech pulls back. At the national level, consumer confidence among white-collar workers is down 34%. Foot traffic in premium shopping areas down 19%. Average purchase size at higher-end stores down 15%. The velocity of money in the American economy is slowing down, not because of the Fed, because the highest-spending consumers are pulling back hard. What we're seeing isn't a market correction. It's a complete reboot of how the American economy works. Let me recap the 3 stages. Stage 1. Tech's high-income spending disappears. Stage 2. The credit system cracks under commercial real estate pressure and collapsing transaction volume. Stage 3. Retail discovers that even rich consumers are cutting back. The era of growth at all costs is over. Tech companies are showing everyone the new model: fewer people, more infrastructure spending, optimization over expansion, margins over growth. This shift is changing how banks think about risk, how retailers forecast demand, how cities plan their budgets. 2026 is going to be the year this fully resets. We're going to see regional banks merge or fail. Mid-tier retail brands go bankrupt. Commercial real estate loans restructured at massive scale. And a permanent drop in white-collar job creation. This contagion might just be the start of something much bigger. The question isn't if this continues, it's how deep it goes and who survives. Next video, we're looking at the silent crisis hitting professionals directly. The silent job crisis. Why $150,000 roles are disappearing forever. We'll show you the data, the industries being hollowed out, and what this means for the next generation of workers. If you want to understand where the economy is actually heading, not just the headlines, subscribe to Silicon Insight. Hit the bell so you don't miss it. Because the best time to understand a contagion is before it reaches your neighborhood. I'll see you in the next analysis.